Good day and welcome back to the 50-Day Property Challenge brought to you by EDBF Property Academy and Private Property. Today is day 17 and for the last time we've asked our challengers to watch the videos we've created on property investment fundamentals while going out in search of their first property in this challenge. Enjoy session 5 as we teach you all about deal analysis, protecting your wealth and property as a business.
Hello all property enthusiasts and welcome to this session 5 of Property Investment Fundamentals. I am Nigel Adriansi, your host, and I come to you again from our incubator here in Pinelands, Cape Town. Today we want to talk about things like income versus cash flow, financial metrics, protecting your wealth, and a range of other things that hopefully we'll get through in this session. So let's jump straight into it. And let's talk about income versus cash flow. It is very important to understand the difference between the two for both accounting and tax purposes. Income for a property company is all inflows of rent, municipal recoveries, operating cost recoveries, and other sales. Net income before tax is gross income, all those things I've just spoken about, less all expenses that are not of a capital nature. By this I mean, when you pay your bond, you have two payments that you're actually making. You're making a payment of interest and you're making a capital repayment. From an income perspective, and when you calculate your net income, you do not record the capital portion of your bond payment. Net income after tax is the gross income, less all of your expenses, less your tax, and those expenses being not of a capital nature, as I said. That is your net income after tax. So you get net income before tax and you get net income after tax. Obviously the difference is the tax that you pay. Now the reason why this is important is because on the one hand, you're needing to record your income and expenditure in your income statement. And this is important when you calculate your tax. When you calculate your tax, you do not include that capital payment that you made on your bond and any other capital payments that you made within your property company. So you may potentially have bought furniture. That is a purchase of a capital nature. You cannot write that off as an expense unless an item is under 7,000 Rand. Then the receiver of revenue allows you to write it off in that year. You can, however, write that off over a period of time if it's more than 7,000 Rand. And depending on what the item is, if it's equipment or furniture or something else, you can write it off over a period of 3, 5, 10 or 20 years. And when you write these assets off, you call it depreciation, and that depreciation then can be calculated in as an expense, and therefore your tax burden is reduced. But the capital portion that you've paid does not get deducted as an expense, and therefore you will pay tax on the income that does not include those portions, only your expenses. All right, the next thing is cash flow. And I'm highlighting these two things because I want to show the difference. Income does not include your capital expenses, whereas cash flow does. Cash flow is the net sum of all your cash inflows, less all of your cash outflows, including your taxes and all the payments of a capital nature, but excluding non-cash items such as depreciation. So you see why I brought up the depreciation issue, because in cash flow depreciation does not get calculated, whereas in your net income depreciation does. Net income is taxable, while net cash flow is not taxable. Net income, you then calculate if it's a Pty limited company, for example, you pay 28% tax of your net income after all expenses, so your income minus your expenses. Whereas net cash flow is the monies that came in minus the monies that went out, the actual cash. So your rental and all of those other incomes minus all of your expenses, including your bond payment, including your taxes, but excluding depreciation, because that is not cash. That is a paper trail that you could record for tax purposes. All right. So you need to be clear about these two things, and the reason why you need to be clear mainly is because of your tax implication, but also to understand what your cash flow would be on a monthly basis. Those are the two reasons why the difference between your net income and your net cash flow is so important. We go through this in more depth in our course. So if you want to understand a little bit more about that, obviously you will have to sign up to our program and take one of our tablets that I spoke about in our previous in session 3. But suffice it to say that for now, all you need to know is that from an income perspective, that affects your taxes, whereas your cash flow perspective, that affects the amount of money you have in the bank at the end of every month. And the difference between the two is mainly the issue of items that are of a capital nature. All right. The next thing I want to talk about is financial metrics. You need to understand financial metrics when you want to calculate whether a deal is feasible or not. Financial indicators are a key element of successful investing. They give you the confidence you need to make an informed buying decision. They are not based on opinion or emotion, but rather on fact and logic. And when you buy property, you need those last two things, facts and logic, not emotion and not opinion. You should use these metrics to understand and validate any deal that you pursue. And the reason you need to do that is because when you calculate the validity of a deal, the viability of a deal, and the feasibility of a deal, these financial metrics will help you to calculate all of those things and tell you whether a deal is good or not from a financial perspective. And let's face it, when you're an investor, when you are investing in property, you are not investing for emotional purposes. You are not investing in a property because it looks nice. You are investing in a property because you can make money from it. And the only way you can work that out is to use these financial metrics. So let's talk about these financial metrics and what they are. So the first one you need to know is internal rate of return. The internal rate of return is a measure of an investment's expected future rate of return. As the IRR is an estimate of a future annual rate of return, IRR should not be confused with the actual achieved investment return of a historical investment. So you're not looking back, you're looking forward. If you're looking back, then you're only looking at the historical returns that the previous owner has received. You need to look forward to say, what are the expected returns that I am going to get into the future after I've purchased this particular property. Your internal rate of return tells you that. The next one is your normal rate of return on investment. Return on investment is a ratio between the net profit and the cost of your investment. Quite easy calculation as opposed to the internal rate of return, which is quite an onerous calculation. Return on investment is your net profit divided by the cost of your investment. So let's say your rental income is 100,000 a year, your expenses are 90,000, so your net profit then is 10,000 for the year. And let's say you spent 800,000 buying the property, another 80,000 on your legal fees, and another 120,000 fixing it up, getting it ready for rental. If you then take all of that together, you calculate, you get to R1 million. And in order then to calculate your return on your investment, you take the net profit of 10,000 and you divide that by the R1 million, which will give you 1% return on investment. Quite a simple calculation. The next one is your gross and your net yields. Similar to the return on investment, except that in this case, you take into account only your gross income on the gross yield and your net income on your net yield. Okay, so be careful when you calculate these two. The one is only with your income, the other one is after your expenses. Gross yield is everything before expenses. It is calculated as a percentage based on the property's cost or the market value divided by the income generated on the property, whilst the net yield is everything after expenses. So let's take that previous example again. If you take 100,000 Rand gross income and you divide that by your million Rand cost, your gross yield is 10%, whereas your net yield is 1%. So almost exactly the same as your return on investment. There is a bit of a distinction, which we get into in more depth at a later stage. So it takes into account all the fees and expenses associated with owning a property. As I said earlier, you take what you bought the property for, you add on all of your legal costs, your transfer duty, all of that stuff, and on top of that, whatever renovations you've done. All of those costs is the cost of your investment. So when you calculate these things, you take the net income or the gross income, you divide by all of those costs. As such, it is a far more accurate way of calculating an actual yield. It is also much harder to calculate as most costs are variable. What I'm saying here is that because your net yield, so we're talking now about net yield, your net yield is calculated on your net income divided by your gross, your total costs. But because you don't actually know what your expenses are going to be in the future, it is an estimated yield. All right, so the difference here between return on investment and your net yield calculation is that your return on investment is based on actual numbers, whereas your net yield is on expected numbers. So if you're expecting a million Rand, you've spent R1 million, you're expecting 100,000 Rand gross income. So your gross yield is expected 10%, whereas your net yield, you're expecting 100,000 income, you're expecting 90,000 Rand of costs, of running costs, and therefore your net yield is an expected 1%, because you're working on expected numbers, not what is actual, what's already happened. You're looking forward and you're saying, what do I estimate my rental income to be? What do I estimate my bond cost to be, or at least the interest on it? When you're calculating these numbers, you do not use your bond, because again, your net income does not include your bond cost, your capital part of your bond cost. It only includes the interest. So when you calculate your net yield, you are taking off only the interest portion of your bond repayment. Remember that. All right. The next one is rental escalation. You need to know what the expected rental escalation is going to be in that particular area, in that property, in that community, etc. So you look at the community and you say, what is the normal rental escalation in this particular community? And you can then assume that that is the type of escalation that you could use. The percentage escalation of rent from 1 year to the next is what they call your rental escalation. So if, for example, you're receiving 10,000 Rand a month and you want an additional 1,000 Rand next year per month, so it's 11,000 Rand, that escalation is 1,000 Rand. If you take the 1,000 divided by the 10, that's a 10% escalation. If, however, you can only get 500 Rand extra, you divide the 500 by the 10,000, that's 5% escalation. That is the escalation or the change in rent, the increase in rent that you receive from 1 year to the next. This is an important calculation when you are going to work out your future income and your future cash flow. Because if you don't know what your rental escalation is going to be, you don't know what your rent's going to be next year. So you need to know that percentage. The next one is your net present value. Now this calculation generally you only use when you're either buying or selling, or when you want to calculate what the value is of your property at any given point in time. Net present value applies to a series of cash flows occurring at different times. The present value of a cash flow depends on the interval of time between now and the period of the cash flow itself. It also depends on the discount rate you use, and net present value accounts for the time value of money. So let me just jump into that for 2 seconds. Time value of money can best be described by the price of a burger. Let's take McDonald's as an example. If you bought a McDonald's burger 5 years ago, you probably would have been able to buy it for, let's say, 15 Rand. Today, you'll probably pay for that same burger, nothing's changed, that same burger today will cost you 30 Rand. So 15 Rand 5 years ago, 30 Rand today. The time value of money is determined then by the difference between what a burger was worth back then to what it's worth today. So the time value of money tells you that the longer you go into, or the further you go into time, the more expensive goods become and the less valuable your money becomes. So 100 Rand today is not going to be worth 100 Rand in 5 years' time. It's going to probably be worth about 50 Rand in 5 years' time. Just as 100 Rand 5 years ago is probably only worth 50 Rand today. And that is because of inflation. Because of the cost of goods going up, the value of your money, or what you can purchase with that money, goes down. So if you account for the time value of money and you calculate the net present value of an asset, you'll then be able to say, today my asset is worth X because the escalations on my rental income, and that's 2.4, my rental escalations will be 5%, 8%, 10% over the next 10 years. The expenses will escalate at, say, inflation or maybe a little bit higher over the next 10 years. And then, calculating that with my discount rate, I can work out what the value of my property is today, my net present value. Now, like I said, this calculation is generally only used when you want to buy or sell a property, or when you want to value the property for your financial statements. Then you use the net present value calculation in order to see what your property is worth today. Now, this is a very complicated calculation, and there are lots of calculators out there that you can use, financial calculators that you can use in order to calculate any one of these 5 different financial metrics. You need to familiarize yourself with these. And the reason why you need to familiarize yourself with these is so that you can always understand the value of your property. All right. The next thing we're going to talk about is analyzing your deal. Like I said, don't let your emotions get in the way of the deal. The value of a deal is in the numbers, not in the emotion. So we're going to talk about some tools on how to analyze a deal and whether that deal is worth doing or not. So some of those tools that you can use: Lightstone, TPN, Property 24, Private Property, and there are a number of other tools that you can use, but I will highlight these ones because they are the most popular ones to use. All right. So the first two that we're going to talk about is Lightstone and TPN. Now, on these tools, you can get, number one, basic information. You can get the earth number, the address, the municipality, the size of the property, previous prices that the property was sold for, who the owner is. You can get owner's details, contact information, last selling date, and a couple of other things. That's the basic information you can find. Then you can get comparative analysis on these different platforms. You can get an understanding of the value of the property when compared to other properties in that particular area. You can look at properties that are of similar size, and even properties in the same street. What have those properties sold for in the last 12 months? And then get a comparative selling price for your property, or the purchase price for the property that you're looking to buy. You can also get bond details, understanding the amount of the outstanding bond. Registration date will give you an indication of the value and or the equity available in the property. So when you look at that property on these platforms, you'll be able to actually see what the last bond was of the previous purchaser, the person trying to sell to you. What was the bond that they took out when they bought the property? How much did they buy it for? And what equity there is then or what equity was there at the time, and what equity is there currently in the property. You'll get an average market price, and you'll also get a municipal valuation. And you'll be able to then do comparatives and see what the equity is available to the seller that's trying to sell to you. You can also get suburb trends. This information helps you to understand the area market. Is the area appreciating or depreciating in value? What are the average selling and rental prices in the area? What are the average escalations, default rates, tenant profiles, and a lot more information that you can get from these two, just these two profile or platforms to get enough information for you to analyze the deal that you're about to do. All right, the next two things or platforms that you can use, Property24, Private Property, and other such property platforms. In these platforms, the kind of information that you can get is very area specific. So area specific searches you can do. Both these websites and others allow you to search for properties in specific areas anywhere in the country. So you can type in, let's say, Pinelands, where I am at the moment, and you can then say, in this area, I want to look at properties between 500,000 and 3 million rand, 3-bedroom homes with 2 bathrooms, garage, any criteria that you are looking for. Then you press the search button and it will pull up all of the information on the properties that are for sale in that range of criteria that you've put in. Or you can just leave all the criteria at any or blank, and it will bring up all of the properties that are for sale or for rental in that market that you're looking for. It can give you purchase price analysis. So if you're looking at a property and you're saying what in the Pinelands area, what are the average prices? You can look at that. They allow you to search within your price range or look at a broader price range to see what the average selling prices are in your area. You can look at rental price analysis. The same thing with purchases, you can also do with rentals to see what the average rental prices are within the community that you are looking to invest into. It also has a real estate agent finder, where if you can't find the estate agents in the area, go to one of these platforms and you'll be able to find in the area that you want to invest in who the estate agents are, contact details, the whole lot. These tools are extremely helpful when you're trying to analyze a deal, because once you have all of this information, you can then go back into the financial metrics and calculate what the purchase price should be for the property that you want to buy. All right. The next thing I want to talk about is protecting your wealth. I always say when I talk to my students, it is much easier to make money than to hold on to it. Making money is extremely easy, but holding on to that money is much more difficult because we have expenses that we have to pay. We have a lifestyle that we want to lead, and we want to buy things. We want to live a good life. We need to eat. We need to get dressed in the morning. So we need to buy things. So it's much easier to make money than to hold on to it, because we just want to buy things. We are consumers by nature. So, in order to protect your wealth, there's a couple of things that you need to do. You can decide to purchase your property and structure it in several different ways in order to protect your wealth. If you do it in your personal capacity, purchasing property in your own name, it is very risky, as the expenses you and your family normally spend things on, that is an external risk to your property portfolio, because in your personal capacity you want to buy things. So if you buy the property in your own name, that income's coming to you, and you would then spend that money. I would never recommend that anybody purchase property for investment in their own name, unless of course the bank will want you to stand surety for that property. Then they may insist that you buy it in your own name. But normally I would not recommend that you buy property in your own name because of the risk factor. All right, then you can go and you can register a partnership. Again, the risk is similar because now you have a bunch of people that have come together to buy property, but again, you're buying it in a partnership which effectively uses your own name. And then there's the issue of several liability, so joint and several liability. Because what happens when the bank says to you, as a partnership, you need to stand surety, they will normally ask you to stand joint and several, to stand surety in a joint and several way. And what that means is that if they cannot collect money from the one partner, they will want to collect it from the other partner. And that's the danger of buying property in a partnership. All right, the next option is a private company. Now, this is one of the key ways that I would recommend you invest. In a private company, the private company itself is a juristic person, which means it can act, it can sign contracts. Obviously, the company itself doesn't have the capability physically to sign the contract, so the directors of the company will sign on its behalf. But the company is a legal entity. It can be sued and it can sue others. So, because it is a legal entity, it stands separate from you as an individual. So when the bank lends the company money, unless they're asking you for surety, they will hold the company responsible, not you. The only caveat here that I would insist on, and that you must be careful of, is that when you do it, when you buy property in a company, that number one, if you're standing personal surety, you are still personally liable. And number two, if you act recklessly in the company, if you trade recklessly, the bank can still go after you in your personal capacity, because as a director, you have traded recklessly. Those are the only two caveats that I have here. But generally, buying a property in a company protects you and your family unless one of those two things, you've either stood surety or you've traded recklessly. The next option is a public company. A lot more onerous, a lot more difficult to control, because here you can buy property in an entity similar to a private company, but here you have more than 50 members or more than 50 shareholders. For a private company, you can only go up to 50 shareholders. For a public company, you can go more than 50 shareholders. Now, the difficulty here is that you have to make sure that your corporate governance is in place. Because here, if your corporate governance isn't in place, then the minority shareholders, the other people that are part of the public that have bought shares, it will be easy for them to sue you in your personal capacity as a director of the company, because again, because you have not managed your corporate governance properly, they can sue you because of reckless trading. So in this one, it's beneficial because you can get more investors, more than 50 investors, whereas it is more onerous because you've got more to do from a corporate governance perspective. All right, the next one is cooperatives. This is again a bunch of people that have come together. You've similar access to and benefits to that of a public company, but a bit less regulations. You don't have as much corporate governance that you have in a public company, but and an additional benefit is that you can also get government grants. I believe that the grant is currently about 300,000. I speak under correction, but as a cooperative, you can actually get money from government. They'll give it to you. You never have to pay it back. So that's another one of the benefits of a cooperative. The fact that number one, there's slightly less corporate governance, and number two, you also have these government grants that you can get. However, it's also very difficult to manage because of the number of people, and you really need to have a good team behind you from a legal, accounting, and tax perspective in order to manage these kinds of setups and entities. All right, the next one is trusts. Now, I'm not going to spend a lot of time on this because in our next session, we are going to talk with our legal advisor, Meyer de Waal, and he will talk about all of these different setups and how you can structure your business. But the point that I'm trying to make here, with all of these is to make sure that you structure your property portfolio correctly in such a way that it not only protects you from being sued, it protects your family from having the risk of having a bad credit record, but it also protects your wealth in that you've structured it in such a way that it is in a formal structure and you pay less taxes. That is another very important thing. Within some of these structures, depending on what your investment criteria is, what your strategy is, you will pay less tax in some cases. Okay, now I want to touch on property as a business. If you don't think of your property as a business, I guarantee you're going to become very emotional about your portfolio. Thinking of your property as a business gives you that ability to step aside from your investment portfolio and think of it in a different light. Thinking of it as an investment and not something emotional that you can become attached to. All right, so number one, purpose. What do you want to achieve? Most likely, you want to achieve financial freedom. All right? If that is your purpose, then when you think about your property portfolio, you then say, okay, now how do I structure, which is our next point, how do I structure my portfolio from a legal and tax perspective in order to achieve that financial freedom? So, what structure will be most effective, least risky, and the most tax efficient? The next thing you then have to think about is finance. How much money do I need to reach those goals that I want to achieve? And where will I find this money? Once you've thought about that, the next thing is to think about your strategy. Formulating a strategy for how you will develop your property business, marketing your product, managing the income and expenditures, and leveraging the growth of that property portfolio. Now, we've spoken about all of these things in an earlier session. We spoke about strategy, we spoke about property, we spoke about structure, we spoke about how to raise finance. And all of these things put together will help you to create your property business, an investment business. And that's the way you need to think about this property portfolio of yours. And then the most important part of this property journey, taking action. You can learn everything that you need to learn. You can come on our course or on any other course that's out there. You can read 1,000 books. You can analyze a million deals. But until you take action and you buy that first property, you are never going to grow a property portfolio. You need to, number one, take personal responsibility. It's not somebody else's responsibility for you to build your property portfolio. If I am your mentor, or any one of our people, or anyone else out there is your mentor, and they have taught you everything you need to know about buying property, investing in property, managing property, whatever they've taught you, it is not their responsibility. It is not my responsibility to get you to buy that first property. You need to take responsibility. The next thing is to be persistent. So much so to the point of obsession almost. When I started the Enterprise Development Property Fund, I made that my primary goal in my career for the rest of my life, to make sure that I educate as many people as I possibly can within the South African context about property. And my aim by 2025 is to have 1 million people on our platform so that they can all know about property investment and not just property as a place to live. That is my ultimate goal. So much so that I'm almost obsessed about it. I wake up in the morning and I don't think about much else except this one thing, to make sure that whatever I do for that day, that at the end of that day, I have achieved the goals that I wanted to achieve in order to reach that 1 million person mark by 2025. So everything that I've done thus far, the incubator that I've set up, the platforms that we have built, everything we've done, all of the connectivity that we have, all of the service providers we put together, we have one focus and one focus only, is to reach 1 million people in South Africa from a property investment perspective. The next thing that you need to consider is ignoring the noise. If you let other people influence you and say to you that what you're trying to do is a waste of time, that what you're trying to do is not going to work, that what you're trying to do is going to lose you money, that what you're trying to do is never going to give you that legacy that you're looking for, you need to ignore that noise, because if you do not ignore the noise, what will happen is that you will become despondent and you will lose faith and you will lose hope and you will lose the portfolio that you are meaning and planning to build. Now, you must remember it won't be easy, but remember that it will all be worth it in the end. It won't be easy because those people, those naysayers, those people that are constantly telling you that what you're doing is not going to work will normally be your friends and your family, because they do not believe that this is possible. They do not believe that you can become financially free. They do not believe that you can build a property portfolio that's going to give you or leave you a legacy that you can hand over to your children one day, which is most likely what you want to do. Those people, as much as they are your friends and they care for you and they're probably speaking out of love, that noise is going to stop you from building your property portfolio. So, take personal responsibility. Be persistent almost to the point of obsession. Ignore the noise and remember that it won't be easy, but it will all be worth it in the end. So that is it from me. I wish to thank you for listening to me over these couple of sessions and for taking the time to start your journey to build your property portfolio and to create financial freedom, not just for yourself, but for your entire family, and to leave a legacy for years and decades to come.
Thank you for joining us again on this day 17 of our 50-day property challenge. Watch us again tomorrow as we continue our journey with Matt L. and Jared Ricketts.